All right, let's get right into it. When a lawsuit finally settles, you'd think the fight is over, right? Well, not so fast. For the IRS, a settlement agreement is basically just the start of a taxable event. And believe me, the way that agreement is worded, it can be the difference between you keeping your full award and handing a massive chunk of it over to the government. So today, we're going to break down exactly how to structure these agreements to protect every last dollar of that recovery.
So to make this real, let's just imagine a hypothetical settlement. Let's say it's for a nice round $1 million. Using this number is really going to show, in stark terms, the incredible financial power of a well-drafted allocation clause. The big question is, how much of this $1 million does the person receiving it actually get to keep?
And boom, here are the stakes laid bare. It's kind of shocking, isn't it? If that $1 million is classified as lost wages, it gets hit with everything. Federal income tax, state income tax, and FICA payroll taxes for Social Security and Medicare. After all that, the net recovery could be less than $550,000. But if that exact same $1 million is allocated to a personal physical injury under Internal Revenue Code Section 104A-2, the entire amount is tax-free. You get the whole $1 million. That's a nearly $500,000 swing based purely on the words in a document.
So to get this right, we're going to do a really deep technical dive. Here's our roadmap. First, we'll cover the foundational origin of the claim test. Then, we'll dissect something called the Gladen capital rule for recovering your investment. After that, we'll hit the all-important standard of adversarial negotiation, navigate the really strict physical injury barrier, look at some protective clauses, and finally, we'll put it all together with the exact language you need to draft the best possible agreement.
Okay, first things first, let's talk about the absolute bedrock principle of settlement taxation. You see, the tax character of the money you get has nothing to do with what you're going to do with it. It's all about what started the lawsuit in the first place. This is what's known as the origin of the claim test, and it makes us ask one simple but incredibly powerful question. In lieu of what was this money paid?
And this whole idea comes from a 1963 Supreme Court case, United States versus Gilmore. Justice Harlan's opinion made it crystal clear. You have to look backward at the source of the fight, not forward at what might happen to your bank account. In that case, a taxpayer tried to deduct his divorce legal fees as a business expense, arguing that if he lost, he'd lose control of his business. The Supreme Court said, nope. The origin of the claim was the marriage, a personal matter, so the costs were personal, no matter how bad the business consequences might have been.
So let's see how this plays out in the real world. If the origin of your claim was a breach of your employment contract, then that settlement is in lieu of wages. Bam! It's taxed as ordinary income. If the origin was, say, the destruction of your factory, the money is in lieu of that capital asset, which means it could be a capital gain or even a non-taxable recovery of your investment. And if the origin was a personal physical injury, the payment is in lieu of your health and well-being, making it completely tax-free under Section 104. You see, the origin is literally everything.
Okay, so what happens when the claim involves a capital asset, like property or an investment? Now this is where it gets really interesting. This is where the Gladen rule comes into play. You can think of this as the playbook for structuring a settlement not as taxable income, but as a non-taxable return of your initial investment, what the tax code calls your basis.
The case that started it all, Gladen versus Commissioner, is pretty fascinating. A partnership bought some land and they specifically paid a premium because they expected to get water rights down the line. Later, when they sold those rights, the IRS and the tax court said, too bad. Your basis is zero because the rights weren't technically yours when you bought the land. But the Ninth Circuit looked at it differently. They focused on economic reality. They said, hey, you paid extra for a realistic expectation of getting those rights, so you absolutely can allocate part of the land's original price as your basis. That move totally changed the game, dramatically cutting the taxable gain.
So the Gladen case and others that followed give us this really practical test. We're showing the four most important factors here. When you're drafting that agreement, you've got to show the rights came from an investment, not from work you did. You want to emphasize that they were purchased. And this next one is absolutely crucial. You have to frame the payment as compensation for a diminution in value of your asset, not as a substitute for lost profits. And finally, you want to highlight the investment risk you took, that you could have actually lost money.
Okay, so you've figured out the origin of the claim. You've used the Gladen factors. You're all set, right? Well, not quite. Will the IRS actually respect your allocation? The answer is only if it came out of what they call a bona fide adversarial negotiation. This means you can't just have one side write down whatever tax language they want because it helps them out. It has to be a real negotiation.
These two cases perfectly show you what that means. In Robinson, the defendant bank just didn't care how the settlement was allocated. They basically told the plaintiff, do whatever you want, giving them unfettered discretion. So the plaintiff allocated 95% to non-taxable claims. The court saw right through it and threw the whole thing out. It was a sham. Now contrast that with McKay. There, the defendant, Ashland Oil, was hostile. They had a real business reason, their reputation, to fight tooth and nail against allocating any money to a RICO claim. Because there was a real fight, the court respected the final allocation. The takeaway is huge. The defendant must have a real, documented reason to care about how the money is allocated.
All right, let's switch gears and talk about the biggest prize in settlement taxation, the complete 100% tax exclusion for physical injuries under IRC Section 104A2. Back in 1996, Congress made this exclusion much, much harder to get. The law now draws a very, very bright line between damages that start with a physical event and those that don't.
Here's the path to a tax-free recovery. It has to start with a physical event, let's say a car accident. That event leads directly to a physical injury, like a broken leg. The emotional distress, like depression, then arises from the physical pain of that broken leg and the tough recovery. Because the origin of everything was purely physical, even the damages for the emotional distress are tax-free under Section 104A2.
But, and this is a massive but, here is the trap that so many people fall into. This time, it starts with a non-physical event, like workplace harassment. This causes emotional distress, anxiety, stress. Then, that stress starts to cause physical symptoms, like ulcers or migraines. Now, even though the symptoms are physical, the origin of the claim was non-physical harassment. The law is brutally clear on this. Physical symptoms that result from emotional distress do not count. The entire settlement is taxable.
And here's another great example of a trap, this one involving the famous basketball player Dennis Rodman. In a case called Amos v. Commissioner, he settled a physical injury claim. The settlement agreement had a confidentiality clause, but it didn't assign any specific dollar value to it. So what happened? The tax court stepped in and said, well, confidentiality is a service, that's taxable. They then just arbitrarily decided that 40% of the entire settlement, a whopping $80,000, was for that clause, and they made it taxable. What a costly mistake.
So you see all these risks and all these traps. How on earth do parties protect themselves in the contract itself? Well, this is where you use tools like Tax Indemnification Clauses. They are basically designed to figure out ahead of time who's going to be on the hook if the IRS comes knocking later on. So, an indemnification clause usually shifts the tax risk from the defendant who's paying the money over to the plaintiff who's receiving it. The defendant's biggest nightmare is the IRS reclassifying the payment as wages, which would make them liable for all the payroll taxes they didn't withhold. But for the plaintiff, the danger is a clause that's written too broadly. For instance, some include a duty to defend, which could actually force the plaintiff to pay the defendant's legal fees in an audit. That's why a critical tip for plaintiffs is to always negotiate to exclude the employer's share of FICA taxes from any indemnity you agree to.
Okay, we've covered the theory, the court cases, the traps, everything. Now it's time to get to the playbook. This is the practical, hands-on, specific language that puts all of these principles to work right inside your settlement agreement.
First rule, never, ever, ever accept a single lump sum payment. It is a tax disaster just waiting to happen. You have to use what's called a bucket approach. The clause needs to spell out exactly how much money is going to each different legal claim. Something like X dollars for lost wages, which will be reported on a W-2, Y dollars for taxable emotional distress, reported on a 1099, and Z dollars for the personal physical injury, which is excludable under Section 104A2, so no tax form is issued. This level of detail is your best defense against an IRS challenge.
All right, next. If your settlement involves a capital asset, you need to call out the Gladen rule by name right there in the text. The language should say something like, the payment is for the permanent diminution in value of a specific asset, and that the allocation is made pursuant to the principles of Gladen v. Commissioner. Doing this is like putting up a big sign for the IRS that says, hey, we are treating this payment as a non-taxable return of capital, and here's why.
And third, remember that Dennis Rodman case, the Amos trap? Well, here is the beautifully simple fix. You have to explicitly allocate a specific and reasonable dollar amount for that confidentiality clause by clearly stating that, say, $1,000 represents the fair market value of this promise. You completely shut the door on the IRS coming in later and just making up some huge taxable number.
So, let's just quickly recap the absolute must-knows from all of this.
Number 1, the origin of the claim is king. That's from the Gilmore case. 2, your allocation is only valid if it's the result of a real adversarial negotiation, just like in McKay. 3, the Gladen rule is your best friend for recovering capital basis. And 4, drafting precision is everything. General lump sum payments are a recipe for a tax disaster. You have to use granular, specific buckets.
And all of this brings us to the one final question you absolutely have to ask yourself. You might know, in your gut, that your settlement reflects the true economic reality of the claims, but that's not enough. The real question is this: does the written text of your agreement give the IRS the clear, undeniable evidence it needs to prove it? Because when you're in a tax audit, the only thing that matters is what's on that piece of paper.